Real estate is more than a transaction. It's a mechanism of building, protecting, and transferring generational wealth. There, I said it. Hi, I'm Melissa Tierney, and this is part one of a series of three different webinars that encompass the basics of 1031 exchanges, how to bulletproof your 1031 exchange, how to build wealth and defer, minimize, maybe even eliminate capital gains taxes. Why do we want to eliminate them? Well, because they're the number one enemy to wealth building. And whether you have one property or 10, you're thinking of potentially investing in more property, or you're already investing in property, you're in the right place. And I'm so glad you're here. So the purpose of doing this webinar is one, for you. There aren't a lot of people who talk about these. It's 1031 exchange is not very widely educated upon. And so I'm doing this to empower you through education. But I want to essentially demystify the 1031 exchange process, because the 1031 exchange is such a great and underutilized tool for building, protecting, and transferring of generational wealth. So you will have questions. Definitely take notes. And there are a lot of situations that will warrant more in-depth questions. And that's where I say, book some time on my calendar and we can do a 30-minute strategy session. I do them all the time. There's no obligation. So as I mentioned, this webinar is actually divided into three parts. The first will be my portion, kind of walking you through who I am, the team that I'm on, why we do what we do. And then I'm going to demystify the 1031 exchange for all intents and purposes. And then the second portion and the third portion will be my partner, John Taylor at JRW Investments. We'll go through his portion. He is a registered representative at JRW, and so he will go a little bit more deeply into the nuances of 1031 exchanges with some DST content as well. So before we really dive in, full disclosure up front, I am not a CPA, I am not a lawyer, I am not a financial planner. I am a licensed realtor with a certification in real estate planning, and I only make money when real estate is purchased or sold. So I have no kickbacks or any kind of incentives for me to give recommendations other than to just empower the public with information that I see and have experienced both in my personal life and in my professional life. So my intention is to show you that real estate is more than a transaction. It's a business. It's a bona fide method to building, protecting, and transferring generational wealth. So, like I said, my name is Melissa Tierney. I am a real estate planner. And what is that? I get that question a lot. So, as a Keller Williams certified real estate planner, we understand and do real estate differently than most agents. One of my clients described the real estate planner as someone who focuses on real estate as the actual business that it is. And as mentioned, my name is Melissa. I'm licensed to practice real estate in the state of California. Things I like to do for fun are hanging out with my boys at the beach, wine tasting with friends. I really enjoy farm to fork type of cuisine with some of my homemade sourdough bread. Yes, I'm one of those people. And if you are too, please put a bread loaf emoji in the comments so I know I'm not the only one. And after I became a licensed realtor and gained some experience in the field, I took it one step further and joined Keller Williams's exclusive real estate planner community and became a licensed real estate planner. Now, this isn't something that you push a few buttons, sign up for, and subscribe to. There's a lot of work involved in becoming a certified real estate planner. And there's networking, there's education. You got to take courses on topics, and you got to pass exams. And it's a lot. It's very rewarding. And I'm grateful every single day to be a part of it. So the thinking here that you see on your screen is that every family has a family financial planner, an attorney, and somebody who does their accounting, a CPA. Now, I am neither of those things, but my question to you is, in light of that, who is managing your family real estate? So I hope you have a family accountant slash CPA. I hope you have a family attorney. Heck, I hope most people have a family therapist, but we're not going to go there. And I hope that you have a family financial planner. And after today, I'm hoping that I can check that final box for you so that you can say with confidence that you do have a family real estate planner and you do have a very rich and knowledgeable team of advocates to support you throughout your journey. So in the capacity that certain financial people manage stocks and bonds, I do that for real estate. And in that process, I help to negate family disputes over real estate and hopefully even capital gains taxes from selling real estate. And the result is the wealth that has been in your family for so long that you and your elders have worked hard to build over time actually stays in your family. And bonus point, said wealth can even potentially bless your family members and next of kin. More on that later. And just one last final disclaimer, the purpose of this webinar is not to give you any kind of advice, but as I said in the beginning, sole purpose is to empower you with education about how creating a real estate plan can help you to build, protect, and transfer generational wealth. So I am on a team. We are called the Complete Real Estate Group. We are powered by the Keller Williams brokerage, and our team consists of, well, right now we're at 18 people, real estate planners from San Diego all the way up to San Francisco. Our mission is to work with families to defer, minimize, and eliminate capital gains taxes on real estate. And I feel we all earn our money by what we do for a living. And at that point in time, we do get taxed on it. We also get taxed when we buy property. The last thing we want to do is get taxed on exiting the property, especially since we paid for all that maintenance and upkeep. So together with the right groups of people like your family financial planners, your CPA, your trust attorney, etc. We come in and we look at things like your cost basis, and we come up with some really close estimates of what we think your tax implications could be. And we come up with a strategy that will ideally minimize or eliminate those taxes. So again, this purpose of this webinar is to not give you any kind of legal financial advice. But we are just know that as we really get down into the technicalities of what we have to say. So I hope that the takeaways you get from this webinar are that you're clear on the role of a real estate planner. We do more than transact real estate. We come up with strategies that other people just don't know how to do. So we're also going to talk about what's going on in the market, kind of what we saw in the unicorn years and how it's still affecting us today. We're going to talk about all things capital gains taxes at a very high level. We're also going to talk about the what, the why, the how on 1031 exchanges. And then my partner, John Taylor, the registered representative at JRW, is going to take over the second and the third parts with DSTs and 1031 exchange technical overview. So definitely my contact information is on the screen. Please take a screenshot of this with your computer or your phone. Save my number and my email. I definitely want you to reach out to me personally and ask me your questions. And I'm here as a resource to just help you power through. So normally when we do these, I do these a lot in person. And when I do them, I always offer to people that if they book a strategy session with me after a seminar, they definitely are valued at over $500 and schedule one with me. There's no cost, there's no obligation. We will talk about your real estate portfolio, how to make real estate fund, maybe long-term care, protect your assets, transfer assets to the next generation. That's one of the many reasons why our country's so great, is because you can actually do things like that. So take a screenshot of this, save my number, send me a text. If at any point you lose my number, it's in the description of the YouTube channel and in this video. So definitely want you to have in the back of your mind that there's always an option to schedule a free strategy session with me. So our specialty at the Complete Real Estate Group is working with investors, wealthy clients, and families in building out their legacy plan. More details on that to come. I will look at a real estate investment portfolio from a real estate perspective. This includes conducting what we call an asset performance test. We like to assess what potential capital gains taxes there could be using our spreadsheets with the commonly known tax rates and other things. And we also like to analyze returns on investments because, and we'll go into this in just a little bit, there are two different types of properties that you live in. You have your primary residence, which is an emotional decision, and then there's your investment property, which is a business decision, and it should be treated as such. So we do these kinds of tests because it's treating it like the business that it should be. So we are firm believers in the saying that teamwork makes the dream work. We like to bring in your team of advocates who we believe to be at minimum, you know, your family financial planner, any advisors you have, your family attorney, and even some of your trustees. We like to bring everyone to the table to talk very openly and honestly about what we're seeing to make sure that everybody is aligned. And speaking of alignment, have you ever heard of a situation whereby an inheritance takes place and now all of a sudden there's a family feud going on? People are not speaking to each other. Weird how that happens. I've seen a lot in this space, particularly, for example, with trust attorneys who warned the family that there will be either a massive tax bill or other consequences involving people squandering or misplacing money. I mean, the list goes on. They don't have a lot of access to family feud prevention tools. And I feel that a big part of that lies actually in a real estate strategy session. So we do have the tools for that. And I know that sounds kind of interesting, but we have a couple of case studies that I will be showing you about family feud prevention. But essentially is we really try to work with everybody at the same table to ensure that a very holistic approach is taken with regards to the family real estate and make sure that it's all done in the most advantageous way for the trustees involved. And hopefully we can leave a dispute-free, capital gains tax-free family legacy. And like I said, we will be doing a couple case studies on that later in this webinar. So lastly, the Keller Williams Real Estate Planner Network is very, very vast. There's over 500 of us certified real estate planners in the country now. And the team that I'm on consists of 18 planners here in California. We work very closely, and both our team and the Keller Williams Real Estate Planner community meet once a week to talk about what we're seeing. We do a lot of masterminding to kind of help each other talk through challenges that we're experiencing. And that does carry over into, you know, how we address things and the things that we recommend to our clients. So in theory, if you meet with one of us, you essentially have access to the same information that we do. So last page on this, and in going through the real estate planner certification, there are a series of courses that we take and additional designations that are involved with that. And one of those is becoming certified for senior relocation services, which comes with knowing how to help seniors to downsize and transition into retirement living. And this piece right here is what got me into real estate, because I did this with my own grandmother. It's funny to know that there are many resources at the library for raising children, but what planning and resources are available to people who have lived in their homes for so long to usher them into retirement living or their next phase of life? What support is there for people who have an aging family member? It's not just the senior in the family who needs the support, by the way, it's the entire family as well. And I have many resources for families as part of being the complete solution for seniors and their families. Something else that's interesting to know is that most homes are owned by seniors. Did you know that 1 out of every 3 properties in the United States are rentals? Many of these investment properties are, surprise, owned by seniors, whether they're accidental or purposeful investors. Whether it's help with downsizing, knowing which retirement communities would be a good fit for them, which trust attorney to recommend, we have the resources to bring to the table because we know every situation is very unique, and that's why we immerse ourselves in the community to the degree that we do. So moving down this list, we understand that trusts and probate. We also have I have a seminar that I teach on trusts, and it's called the 21 Things Trustees Need to Know. The last thing a trustee wants to do is to figure out their responsibilities when they're in the middle of grieving or just in a sticky situation. So I highly recommend to people that if they have their home in a trust and they have trustees, that they take a minute to educate them on what those responsibilities are. And that's why I do that seminar. Legacy and family feud planning, I already touched on. We do have investors that we work with for fix and flips, BRRRR method, and various investment opportunities. Get in touch with me to get the specifics on those. Even if you're already doing your own, I definitely want to make sure that you get another set of eyes on what you're doing to ensure that your assets are optimally performing so that you can meet your future goals. So as mentioned, we're going to cover many things. It's important to understand the market outlook, how to build and transfer wealth. Think of it as secrets of the wealthy, if you will. There are many reasons that maybe you haven't heard of them, but rest assured that everything we talk about is 100% legal and has been done in cooperation with the respective fiduciaries in place. So our whole goal is to help you minimize and maybe even eliminate capital gains taxes because it is considered the #1 enemy to generational wealth. So we're going to go into 1031 exchanges and DSTs at a very high level. Again, I'm not a financial planner, CPA, or attorney. I'm strictly speaking to you from the experience of a realtor, real estate planner, and my intention here is education. And then again, we do this in cooperation with a team because we firmly believe that teamwork makes the dream work. So moving right into talking about the market, it's important to just put it out there that 2020 and 2021 were a lot of people are considering to be unicorn years. We have never, ever seen anything like this. There was a huge boom in demand. We saw 20, 30, and in some cases up to 42% appreciation of prices in certain areas. And the lowest mortgage rates were in some areas as low as 2.65. So, and this was going on up throughout the entire country. And in 2021, I say we as in the state of California, sold 6.8 million homes, which is the highest number of homes that we've ever sold in any one year. Usually our average is about 4.8. So in these unicorn years, we saw the highest rate spike in years, which essentially it tripled from 2-ish to 8-ish. But I do want to draw your attention to and we'll see a graph here in just a moment. Remember in the 1980s when rates were 15 to 18%. Bear in mind, a lot of other things were different at the time. when rates do what they did, and in this case, triple overnight, usually one could expect a crash, or if nothing else, a big correction, which would theoretically be probably about 10% depreciation. And it really didn't even do that. Prices didn't really go down. They only leveled off. The entire state of California only went down by maybe 0.5%. So for people out there who are still waiting for the crash, prepare to be disappointed. It's also important to note, and you can let me know what you think about this, but as the media kept talking about an incoming crash, keep in mind that while that was going on, most of the buyers during that time were actually about 60 to 65% of buyers during that time of homes were insurance or hedge fund companies. So in my opinion, and we can just leave this here, in my opinion, while the media was basically scaring most of the public not to buy, 60 to 65% of transactions were actually done by insurance or hedge fund companies. So moving on, there is a little bit of a lull now. It may look like the market is slowing down because the number of sales across the board are down, but prices are still high. And last year, California sold about 4.6 million homes, which is only slightly lower than average. So we didn't really experience anything too crazy, but it did look ominous when you looked at the number of sales as compared to the unicorn years versus what we're currently experiencing. So something that I tell buyers is that real estate is an ever appreciating sport. You can either buy high now or higher later. If you do have equity in your home, use it. It's only going to keep appreciating. And if anything, the unicorn years really exacerbated our nationwide low inventory problem. Prices may not be appreciating as fast as they used to be, especially here in California. But due to the low inventory situation, it will always be a good time to sell. So since the beginning of the year, buyer demand has picked back up. We are still seeing, especially in Santa Barbara, bidding wars and multiple offers on homes that are priced very well for what they have to offer. We have a lot less homes to sell, so it is a great time to sell if you have a place to go. Many people do not want to apply for a loan that will cost them 7% interest. That is a factor. So where are we headed now? I'm still looking for a crystal ball to, see where we're going. But since I don't have one yet, what I can say is that over 50% of people who own a home, they own it free and clear. 60% of the people own, from an equity standpoint, 50% or more of their home. And over 90% of people have at least 20% of equity in their homes. To date, we are seeing the lowest number of foreclosures. So unless there are some significant life changes triggering a sale, what we're seeing is that many sellers are not that motivated to sell their homes, and they are proving that they're not. So remember that in most recessions, real estate doesn't go down, it actually goes up. And we've already appreciated quite a bit in recent years. So all of that being said, here's the graph that I mentioned. Going to do a little bit of a bait and switch. And now we're going to talk about why real estate is such a great investment, because as you can see, real estate has appreciated on average about 5.6% year over year. One of the reasons why we're so passionate about real estate investing is because if you have, let's say, $500,000, you can leverage that to buy $1-2 million of property, and it will appreciate. If you buy 500,000 in stocks, well, we all know the risks on stocks and bonds, but it appreciates very little. So when you compare to the gap in appreciation, real estate's more favorable. We are seeing prices starting to head back up again, going back to that supply and demand that I mentioned, but also something to keep in mind: when there's nothing to buy, nothing gets purchased, and sales are just down across the board as a result. So when we look at this graph of the median sales price appreciation between a specific period of time, um, we see that their real estate has its dips, but overall, the direction that it went is up. And how many people I've yet to hear somebody say, gosh, I wish I hadn't bought my home 10 years ago or even 5 years ago, because the appreciation has been very favorable for them. And by the way, the true indicators of wealth are how long have you owned your home and how many homes do you own? On the flip side, from a mortgage perspective, another bait and switch for you. From the mortgage perspective, now is actually a great time to buy a house, because when you look at how rates have come down over the last few decades, houses are sitting on the market longer, partially because some sellers are still hanging on to the pricing from the unicorn years. But homes that are turnkey, great opportunities and priced very well, they get sold very fast and usually in a multiple offer situation. So when you're looking at things like rates are not what they were decades ago. They are still low in comparison. And again, true wealth is measured in, do you own a home? How long have you owned it? And how many other homes do you own? So from my perspective on the mortgage side, it's still a good time to buy. So over the course of 2023, we did see an increase in prices last year. And as rates come down, we will see prices go back up again. I really hope that they don't go down too much more, because that's when I think the monkey buying comes into play, where, you get these offers that are just absolutely crazy. They're, the terms are just nuts. And I just hope that that does not become the new norm. So when it comes to analyzing your real estate portfolio, and what we do as real estate planners is we look at the real estate that you have by doing an asset performance test. This would be on any investment properties that you have. And we use a spreadsheet to estimate approximately how much in capital gains taxes we think you will owe. Obviously, your CPA will have the concrete numbers, especially the depreciation. We do provide some pretty good guesses, and it will spare you some sticker shock. But we're basically trying to understand, like, if you were to sell this, these would be the implications. And we look for ways that will limit or defer and even eliminate capital gains taxes. But essentially it comes down to each individual. We look for ways to increase your cash flow, build appreciation. Maybe it's a long-term play that you're going for, or, how quickly do you want to do this and what that number looks like. We look at ultimately what your goals are and come up with a plan for you to achieve those goals. So there are two types of properties, like I mentioned in the very beginning. There are the ones you live in and the ones you invest in. Regarding your primary residence, as long as you live in the home for 2 out of the last 5 years, it is considered your primary residence. And if you were to sell said primary residence, you would qualify for a tax exemption upon selling the home. Single people get 250,000 tax exemption. A married couple gets 500,000. And if there are 3 or more people on title, they each get 250,000. Anything you do not live in, anything that is not considered your primary residence, is considered business or investment. And the sale of those are definitely subject to capital gains taxes at the state and federal level. And that's what we're trying to mitigate and or eliminate. So when we look at some type of net sheet, whether it's bare bones spreadsheet that we use, or it's a net sheet from the title and equity company, we take the sales price, we subtract the cost of selling. Not here to debate, commissions and anything like that, but we usually estimate a cost of selling, including T&E fees and other things, to be approximately 7%, less the loan balance, and that gives us our net proceeds. That's essentially what you would walk away with in that point in time, not including taxes. There are two types of cost bases that we need to know about. There's the step up, which in my opinion you want, or the carryover. So let's say you want to help your kids become homeowners. Adding them to the title of your existing home will hurt them in the long run, because this is what's called a carryover and cost basis. They will absorb what you paid for the home. And when they go to sell it, it opens up a potential for a massive tax bill. The best strategy is to keep the property in a trust. And then upon passing, your kids then get a step up in the cost basis. So, example, if you're trying to bless your kids while you're alive, one of the best things that you could do is help them buy a home. Let's say you buy it, keep it in the trust, and then upon passing, the kids get your portion, the step up in cost basis on your portion. So if they need to sell because they inherited a home at a step up in cost basis, they wouldn't be subject to any capital gains taxes. And this is what we want. This is where that swap until you drop mentality comes into play. And in this situation, this was actually a scenario or a case study from our real estate planner community, because this happened to one of our clients, where the mother was a mother and her son. The mother passed away, and the trust said that the home went to her son. So her son acquired the property upon her passing. And when that happened, he got a date of death appraisal. And so what that date of death appraisal said the home was worth, that's what the son, that's what his step up and cost basis is. So if he goes to sell the home, there won't be any gain, and he won't incur any capital gains taxes. So the key there is the step up in cost basis versus the carryover. So this is just a case study of what happens when in a carryover example. So if you have a parent who adds a child to title, then let's say parent bought the home for $100,000. Now that home is worth $2 million. So if the parent adds the child to, or the adult kid, to the title, and now that kid has absorbed her $100,000 cost basis, if he turns around and sells the home for the $2 million that it's worth, that's $190,000 of gain that he's going to be taxed on. So essentially, there are ways to avoid paying those taxes, and a 1031 exchange could essentially save them lots of money, and it would keep that money within their family. So before we really dive into capital gains taxes, it's important to understand what you have to pay and where. In California, we're number one. We're the highest in the nation, and it's actually, that rate has actually gone up from 13%. Now it's 14%. So yay, we're number one. This is really important, because let's say you have $100,000 in gain on a property. You could expect to pay somewhere in the ballpark of $35,000 in capital gains taxes. And that's not just the state capital gains tax, it's also adding in the federal capital gains taxes as well. And we'll go into that in just a little bit. But for my fix and flippers out there, your taxes are actually higher, and it's based on the income you make, which can be as high as 20%. And then you add on the federal taxes, about 15-20%. And that could be up to about 44% on taxes total. So you've got to be very vigilant to know that there are going to be some times when it doesn't make sense to fix and flip. In my opinion, it's better to buy the home as an investment property, rent it for 2 years, fix, rehab, refinance, and then we 1031 into the next flip. That's how I would do it. Back to the asset performance test that I mentioned, this helps make a very wise decision. What we do is we look for what is the capitalization rate and what's the cash on cash return here. And really what we're trying to figure out is how is your money working for you as a financial instrument? So some people have different equations. Ours are on the screen. You can see how we do, what we calculate and just kind of keep it very general. But basically we go one step further. We want this to be a very smart financial investment. We want to really treat it like a business. And so we also like to see people put from their monthly income. We like to see people putting, for example, an extra 10% away for business expenses, like, for example, new roof, new carpet, new, maybe even rent turnover, and then another 5% for vacancy, because when you put those away in your monthly reserves, then you have a reserve from which to draw for those unexpected costs, and you don't want those to come directly out of your pocketbook. So just little things like that we look for when we do an asset performance test. Here again is what we use to calculate the capital gains taxes. And again, I am not a CPA. Your CPA will have concrete numbers, especially when regards to your depreciation. We always, always, always ask our clients to consult with their CPAs on this. Make sure when you are consulting with your CPA that your CPA actually understands the tax advantages of 1031 exchanges. There are many CPAs who submit paperwork to the IRS and call it good. They don't actually know much in the way of strategizing, and they're not very well versed in the tax laws regarding real estate. So definitely make sure that your CPA is confident enough to give you ways to save money on your taxes with regards to your real estate. So if anything, we'll want to bring them in on our conversation, not to see, what it is they do or don't know, but we want everybody on the same team on the same page with regards to the team and making things work together. So here's where we're going to get into the 1031 exchange. A 1031 exchange is essentially a swapping of real estate investment property for another property and essentially this process allows capital gains taxes to be deferred. You are literally deferring the taxes that you would have paid on one property by buying something. Think of it as the government giving you a pass for stimulating the economy. Essentially, the term 1031 exchange, it's literally derived from Section 1031 of the Internal Revenue Code. And IRC Section 1031 has a lot of moving parts that people really need to be clear on. An exchange can only be done with like-kind properties, and the IRS is very clear about what those like-kind properties are. We'll actually see them in the next slide. And there are timelines that you must adhere to. There's no flexibility on the timelines. So first and foremost, I personally will not work with somebody on a 1031 exchange without the blessing of their CPA. And it's very vital that we're on the same page. So pay close attention to this slide. You may want to pause the video and maybe do a screenshot if you like. People have been under the impression, and not everybody, but a lot of people that I talk to have been under the impression that, for example, if you do a 1031 exchange on, let's say, a vacation condo, they are under the impression that you have to swap one condo for another condo, or there's a lot of misconceptions about what the IRS considers to be like-kind property for a 1031 exchange. Broadly speaking, it's swapping one investment property for another. And essentially, you can change the form of your investment as the IRS sees it. And this will allow your investment to continue to grow as being tax deferred. There's no limit on how frequently you can do a 1031 tax exchange. You can roll over the gain from one piece of investment real estate to another and another and another, which here is where the phrase swap till you drop gets triggered. So although you may have a profit on each swap, you avoid paying the taxes until you sell for cash many years later. And in terms of legacy planning, the idea is to keep swapping until you pass on. And when that happens, there are no more capital gains taxes. So capital gains taxes are not inherited. But you see on the screen the different types of things that one could do a 1031 into. So an investor must designate up to 3 replacement properties within 45 calendar days of sale. It doesn't necessarily have to be 3. It's just you get up to 3. You need to buy something of equal or greater value than the property you were relinquishing, because if there's a difference and the property you're relinquishing is lower, then you're going to have boot, and that's going to get taxed as well. The other thing to note is that you must use a qualified intermediary or an accommodator of some sort, basically a neutral third party to hold the money. So another thing to note is that there is such thing as a 1033 exchange. That's different, but in the 1033, there are different circumstances for that, and you have 2 years. But either way, you do need a CPA on your side to kind of help shepherd you through those timelines and the numbers that you're looking at. So here are just some of the reasons that 1031 exchanges are awesome. And like I said, California has the highest taxes in the nation, and a new mansion tax that just took effect. Woo! So there are actually a few books on tax strategies in real estate. Reach out to me if you would like some recommendations. I just finished a pretty good one that explained real estate tax strategy in very good English. But real estate ultimately it was very interesting to know that real estate is really the way to get around paying taxes, which makes it a very fantastic way to consolidate, diversify, and even do some very lucrative real estate and legacy planning. But here is a sample timeline on the 1031 exchange. This is another area that people get messed up on. Essentially, you have 45 days to identify a replacement property, and then another 180 days to close on it. This is where people get tripped up. Sometimes people do a reverse 1031 exchange where the buying of the property comes first. But just for general purposes, remember that you have 45 days to find it and 180 days to close. I have a few strategies on how to make sure these goals are met, but the biggest one I want to draw your attention to is very, very underutilized, and that's doing a 1031 exchange into a Delaware statutory trust, which you just saw on the like-kind property slide 2 slides ago, and I'll touch on that in just a bit. And the reason why we do that is because people will come to me and say, well, what if I don't find a suitable replacement property? Or what if my own property takes longer to sell? And we kind of go through the usual list of what ifs. But suffice to say, no one on our team has ever failed a 1031 exchange for a couple of reasons. One, in our opinion, escrow, that 45 days of waiting period and escrow I mean, it's crunch time, and in many cases, we push for concurrent closings that safeguard our clients. Another thing to note is that commercial buildings and apartment buildings, those will be longer escrows, and we want to make sure that there's enough wiggle room to accommodate that. And with a DST, DSTs can close in maybe a few days, 3 days, 5 days, maybe a week. You're dealing with a much shorter time frame. So this type of due diligence coupled with the strategy of the DST are the reasons why we've never failed a DS or 1031 exchange. And in many cases, why a lot of our clients have not had to pay, up to 40% in capital gains taxes. So is it a good time to do a 1031 exchange? And in my opinion, if you have equity to leverage, the answer is absolutely. Now, I know that a lot of people who come to me, I see very commonly, they're tired of being a landlord. The new tax laws, especially the ones coming into effect in July, are kind of difficult and scary. And a lot of people maybe even want to leave California. A lot of people even want to help their family buy real estate. You could maybe gift them rent every year as part of their estate plan. I mean, there are a lot of ways to do this, but we have seen a lot of success with people pulling cash from their property and doing a 1031 exchange into a Delaware statutory trust. So just a couple of quick case studies. 1031 exchange under tax code 121, we see these things a lot. And essentially, according to the IRS, you don't do a 1031 from your primary residence into something. But maybe your primary residence has an ADU or a JADU, or there's a garage conversion that can be rented out. Maybe you want to downsize into something with one level, 1,200 square feet. A lot of times I tell people you should consider renting your home out for a minimum of 2 tax seasons. So some people get very, very specific on this, and they'll even do, we have a lot of snowbirds that live in the desert. They do part-time rentals. Suffice to say that assuming that the requirements are met, you will get your tax exemptions. There are a lot of nuances in the tax code, but you could essentially figure out a way to do a 1031 exchange using your primary, but there are all these things that we need to consider. We need to work with your CPA on it. Now, in a case study that we see a lot of these, and one in particular that we saw really exemplifies the transferring of wealth and building a legacy and family feud prevention all in one. So we talk about this particular family a lot, but essentially we have this family, and the mom and the father had 4 kids. And each of these 4 kids, they're very different in personality, very different in profession, very different in all the ways that they can possibly be different. And some of them even live out of state and they have their own families. So in this particular example, the father passed away and the mother, who was managing this apartment building, was getting pretty tired of it. And we call it the terrible tease. She was getting very tired of the toilets, the tenants, and the trash and the taxes, and somebody in one of my seminars called it trouble. So we'll just go with that. She was tired of the trouble. So when she reached out to the Keller Williams planner community, her local Keller Williams real estate planner, and they had a meeting, and they said, well, you know what? You could sell, you could do a 1031 exchange into a DST, or you could do something, maybe a REIT or something else. But here's the thing, tell us about your kids. And so we got to know the kids a little bit, and they said, well, if there's this is a pretty sizable sale. I mean, what if you could bless your kids while you were still alive, would you? She said, absolutely. And so essentially what she did is she sold the property and she did a 1031 exchange into 4 different single family homes for each of her kids. Now, she co-owns each of these with each of her kids. And even though she co-owns them, they are owned by the trust. So essentially, mom used the proceeds of the multi and was able to bless her kids while she was still alive. Um, and when she ultimately passed, the kids received her portion of their home at the step up in cost basis. So it was a win-win for everybody, but nobody had thought of that before. So let's segue into a DST. Let's say that it wasn't the size of the sale that she thought it would be, and mom was just tired of being a landlord, and because she managed it herself her entire life. So essentially what she did was she sold the apartment building and she put all of the proceeds into a Delaware statutory trust. That Delaware statutory trust, which you'll go into in a moment with John Taylor in the part 2, not only did that still pay her income, but when she ultimately passed, the the 4 kids who were the beneficiaries of the trust, they were now the new owners of the Delaware statutory trust, and they got her step up in cost basis. And um, this is the kind of thing where you could either choose to keep it, choose to sell it. Um, the choice is individual. You're not fighting over, or you're not arguing or trying to come to one agreement on what to do with this one asset that mom left behind. So they got the step up in basis at her date of death with in this new Delaware statutory trust, and it's theirs, and they can make a decision on whether to sell or keep. So those are just some of the strategies that we do that encapsulate keeping wealth within the family. And ultimately they do in a lot of ways, they prevent, future family feuds, and they're just all around a very good thing. So what is this Delaware Statutory Trust? So a DST stands for Delaware Statutory Trust, and it is an entity that is used to hold title to investment real estate. The typical investment for a DST 1031 property is going to be about $100,000 minimum. It really allows investors to diversify their exchange proceeds among multiple properties. So DST investments have various leverage ratios that potentially satisfy an investor's exchange requirements of taking on equal or greater debt. And it's structured such that you're buying interests in real estate assets of the trust. So a lot of these typical assets are not stuff that I think someone like me could afford to invest in my lifetime, but a lot of these assets that are in these trusts are big chain grocery stores, big chain pharmacies, Amazon warehouses, healthcare buildings, CNN buildings, basically the big corporations. And we like DSTs for a lot of reasons, but you must be an accredited investor to qualify. This is because the assets are already in there and everything's kind of pre-packaged in the trust. Paperwork's already done. That's why it takes so little time to actually close on them. This is a great solution for tired landlords because you're basically still in real estate. And in my opinion, you're basically doing real estate at a higher level with these types of assets involved. And this is considered by many to be secrets of the wealthy. And I've heard the term CFO investing on this as well. But again, because we're dealing with a trust that already has the appraisals, the reports, and kind of all the things already prepackaged, there's no time crunch when you're working with 45 days plus 180. You don't have to worry about that time frame because these will close very quickly. Just note that at the end of the year, DST investors do not get K-1s, they get 1099s. And your CPA will put it on Schedule E of your tax return. So again, going back to making sure that your CPA is very well versed in tax law. So just to recap the things that we talked about, and definitely feel free to take a picture of this slide for a future reference. Oops. We did an analysis and really just starting at the unicorn years and looking at where we're at now. There are a lot of trends and variables that are still impacting the values of the homes today. We are seeing the impact of interest rates. Interest rates are not as high as they used to be, but they are still what we consider to be high. And we saw the impact of what happened when interest rates essentially tripled overnight. So there are ways to look at how much equity you have in your home, and you can determine, net proceeds based off of the loose calculations that we talked about in the part of the deck with the formulas. There are ways to look at your tax liability. You can do an assessment on your portfolio. Really, the formulas are here for you to do those loose calculations on your own so that when you get the actual numbers from your CPA, you're not as surprised. I mean, you may be off by a couple of, a couple dollars here or there, but ultimately you won't be in sticker shock when you get that actual number from your CPA. So in terms of generational wealth building, there are many ways to do it, and there are many ways to teach even the next generation to build wealth through real estate. And a lot of that, by nature of what they are, will do some form of family feud prevention planning. And that's really what we like to see. And that's kind of the meat and potatoes of why we do what we do. So just to kind of wrap this up, a real estate planner is somebody who thinks like a consultant, acts like a shepherd, and focuses all the activities on the needs of the family as it builds and transfers generational wealth. I invite you to schedule your strategy session today. My contact information is below in the video description, and I'm happy to do a Zoom call with you for 30 minutes just to go over what you've got and answer any questions that you have. There's no obligation to sign any contracts or anything like that. So just last bit of information. This is my contact information. Please take a screenshot of it. Definitely connect with me if you found this webinar valuable. The link for part 2 is going to be below in the description of this video. Go ahead and exit the full screen, find that link, and give it a click. So thank you again for watching. Please let me know in the comments if you found this webinar valuable, and I look forward to connecting with you.